Did you know that Warren Buffett's cash reserves at Berkshire Hathaway are larger than Hungary's GDP? That's right, the Oracle of Omaha is sitting on a staggering $189 billion. But why is one of the world's most successful investors holding so much cash? Buffett has been sending signals about a potential stock market crash, and his preparation strategies are crucial for anyone investing in the market. He emphasizes holding cash to take advantage of market drops, avoiding risky debt, steering clear of speculative investments, and investing in solid, high-quality businesses. So, what does Buffett see that others might be missing? And how can you use this insights to protect your investments? Well, let's find out. Berkshire Hathaway just released its first quarter results. And guess what? Warren Buffett is sitting on a jaw-dropping $189 billion in cash. Every year, investors eagerly await Warren Buffett's annual letter to see what the Oracle of Omaha thinks about the markets, the economy, and his investment strategies. This year's letter was packed with insights, but what really caught my eye were his comments about Berkshire Hathaway's recent surge in cash holdings. As of the first quarter of 2024, Buffett's cash and short-term investments, mainly in T-bills, have surpassed a whopping $189 billion. To put this into perspective, this cash pile alone would make Berkshire the 58th largest economy in the world, just slightly smaller than Hungary. That's an incredible amount of financial firepower. Now, could he be sending Wall Street a subtle warning? Berkshire Hathaway has never held more cash than it does right now, and some market watchers are buzzing. They're wondering if Buffett's massive cash reserve is a quiet signal that the stock market might be overvalued. But is there any truth to that? There are two critical messages regarding Buffett's cash hoard. The first is tied to the sheer size of Berkshire Hathaway, which is nearly a $1 trillion market capitalization. For Berkshire, acquisitions need to be substantial. As Warren Buffett previously noted, there remain only a handful of companies in this country capable of truly moving the needle at Berkshire, and they have been endlessly picked over by us and by others. Some we can value, some we can't. And if we can, then they have to be attractively priced. This statement is crucial. One of the most intelligent investors in history suggests that deploying Berkshire's $189 billion cash hoard meaningfully is challenging due to a lack of reasonably priced acquisition targets. Despite having this massive war chest, the reality is that many potential acquisitions are simply too expensive in today's market. Buffett could acquire companies outright, use a stock cash offering, or buy a controlled stake in numerous firms. However, given the skyrocketing stock prices and valuation over the last decade, finding a good deal has become increasingly difficult. As he famously said, "Price is what you pay, value is what you get." Now, why else would Warren Buffett hold such high cash levels? It's all about being ready to pounce when the market stumbles. Remember 2008? The prestigious white shoe investment firm Goldman Sachs came knocking on Buffett's door, desperate for a bailout to avoid bankruptcy. Buffett was more than happy to help, providing a massive infusion of capital on very favorable terms. During the crisis, those who have the gold make the rules. So, is another opportunity like this on the horizon? The answer is most likely yes. Buffett's massive cash reserve is a strategic move, positioning Berkshire Hathaway to take advantage of market dislocations and acquire valuable assets at a discount when the time is right. Let's break it down. Berkshire Hathaway's cash pile has some people concerned that Buffett isn't seeing many good deals in the current market. Given Berkshire's massive stock portfolio, valued at around $376 billion with stakes in giants like Apple, Bank of America, American Express, and Coca-Cola. Buffett's moves are closely watched. His track record is legendary, delivering annualized returns of around 20% since he took over as CEO. So when Berkshire's cash reserves swell, people take notice. But here's the thing, Berkshire Hathaway isn't just hoarding cash for the sake of it. They prefer making strategic acquisitions of undervalued companies. This cash gives them the flexibility to pounce when the right opportunity arises. Buffett and his team aren't chasing the latest growth stocks. They're hunting for quality companies at reasonable prices. The real story here is Buffett and his team's patient approach to investment. They're not just sitting on this cash for no reason. A hefty cash reserve gives Berkshire the flexibility to act swiftly. If the market crashes, they have the funds ready to snap up shares or even acquire companies outright. This strategic patience is a hallmark of Buffett's investing style. This cautious approach makes sense when looking at the Shiller P/E ratio, or CAPE ratio, now nearly 33. This ratio compared the current stock market price to the average inflation-adjusted earnings over the past decade, giving a historical perspective on valuations. A high CAPE ratio suggests stocks are pricey relative to history, and the current ratio is almost double the long-term average of 17.5. Given these stretched valuations, Berkshire's cautious stance isn't surprising. However, it's important to remember that high valuations alone aren't a reason to sell all your stocks. Other factors like interest rates, fiscal policies, and economic growth also play a significant role, and elevated valuations could persist for a while. So, while Buffett's massive cash reserve might seem like a warning, it's more about strategic patience than predicting an imminent crash. But what other reasons, other than a potential market crash, would cause Buffett to hold so much cash? You see, the size of Berkshire Hathaway's cash stockpile might seem startling initially, but it's not unusual when looking at the bigger picture. Sure, $189 billion is massive, but consider this. Berkshire's market capitalization and assets have also hit record highs. In fact, cash and short-term investments make up about 17.7% of Berkshire's total assets today. Over the past 25 years, that ratio has averaged around 17.1%. So, in relative terms, this cash level is pretty normal for the conglomerate. Moreover, Berkshire's substantial cash pile also plays a crucial role in its insurance operations. With big names like Geico, Allegheny, and General RE under its umbrella, having cash on hand is essential. If there's ever a bad year with significant insurance claims, this cash reserve ensures that Berkshire can meet those obligations without breaking a sweat. Berkshire Hathaway generated a substantial amount of cash in the first quarter. Notably, they sold about 13% of their massive investments in Apple, likely bringing in nearly $20 billion. But don't think for a second this sale reflects a change in Warren Buffett's opinion of Apple. Instead, it's a strategic move for tax purposes. Buffett hinted at the annual meeting that the sale was made to lock in today's tax rates in anticipation of future increases. Although this sale results in a significant tax bill for Berkshire, it still adds a hefty chunk of cash to the reserves. Moreover, Berkshire sold its entire stake in Paramount, likely bringing in around $800 million. While this sale was at a loss, it helps offset the tax burden from the Apple sale, showcasing Buffett's tactical approach to managing the company's finances. Here's another reason they're holding onto that cash. It's making money. With rising interest rates, $153.4 billion of Berkshire's cash is invested in short-term U.S. Treasury bills, earning about 5.4%. The rest is probably earning interest too. So Berkshire is pulling in at least $8.3 billion annually just from their cash reserves. Buffett humorously remarked at a meeting that even if the rates were lower, it wouldn't change their cautious approach. He said they don't use the cash now at 5.4% and wouldn't use it if the rates were 1%. Don't tell the Federal Reserve, he added with a grin. Basically, they're in no rush to spend the cash because it's already working for them, bringing in billions every year. But if truly Warren Buffett is warning for a potential market crash, how do you prepare? First up, hold cash. Warren Buffett advises preparing a significant amount of cash for a market crash. Berkshire Hathaway's company currently holds around $189 billion in cash or short-term treasuries. This cash reserve acts as a war chest, allowing Buffett to protect Berkshire's business operations during tough times and to jump onto buying opportunities when market valuations drop. It's not about hoarding cash, it's about being strategic. Berkshire can snag high-quality businesses at reasonable prices by waiting for favorable conditions. When others are forced to sell assets at discontinued prices, having cash on hand lets you scoop up those bargains. It's all about being prepared for market corrections and making smart investments without the pressure of overpaying. Next, avoid margin debt. Buffett strongly advises against borrowing money to make investments. Sure, margin loans can amplify returns, but they also come with significant risks, especially during market downturns. If the value of your borrowed investments fall, you might face margin calls, forcing you to sell assets at a loss to cover the debt. This can lead to substantial financial losses and even potential bankruptcy. Buffett emphasizes the importance of avoiding margin debt to maintain financial stability and reduce the risk of forced asset liquidation. In volatile markets, particularly when stocks are overvalued, the risk of margin calls increases significantly. By eliminating margin debt, you can safeguard your investments and avoid the catastrophic consequences of market corrections. Buffett's advice here is all about financial prudence and risk management, ensuring you're not caught off guard by sudden market shifts. Buffett advises against getting sucked into speculative investments, especially during times of market euphoria when everyone is chasing high returns. Speculative assets, like cryptocurrency or non-cash producing assets, often have greater volatility and uncertainty. But what's the alternative? Buffett stresses the importance of investing in solid, stable, cash flow generating businesses with a strong track record. During a market crash, speculative assets will likely suffer the most significant declines since their value is driven more by investor sentiment than intrinsic worth. Why gamble on uncertainty when you can invest in something reliable? Focus on high-quality, productive assets to better weather market downturns and maintain confidence in your portfolio's long-term value. Finally, invest in high-quality businesses. This is the cornerstone of Buffett's investment strategy. Look for companies with a competitive advantage, competent management, and understandable business models. During market downturns, these businesses are more likely to withstand financial pressures and bounce back quickly. High-quality companies with strong fundamentals are less likely to go bankrupt, providing a safety net for investors. Investing in such businesses ensure that even if market prices drop significantly, the underlying value of these companies remain intact. Imagine holding onto your stocks without the panic of deciding whether to sell at a loss. Moreover, market crashes often present opportunities to buy these high-quality businesses at discounted prices, boosting your long-term plans. Now, The big question is, are you ready to take action and safeguard your investments like Buffett? What changes will you make to your portfolio to prepare for any potential market downturns? Share your thoughts in the comments below, and don't forget to like, subscribe, and hit that notification bell for more insights and strategies.